What are the different types of loans and how do they work? That's a
that
loaded question.
So loaded. I personally don't do pre-qualifications. I won't touch them. People don't understand how mortgage brokers or lenders or whomever evaluate income, for instance. So they may give me a number and it's completely wrong because they don't understand how it's evaluated. So
this is why it's so important to have a good lender partner. It's not your job to know all of the intricacies in the way that a loan officer is going to know them, right? That's their job to know that. And I'm not saying knowledge is bad. I'm just saying like they have working knowledge and they have expertise that you're not going to be able to get because you're spending your time, helping people transact property. Be the connector to the expert.
I can't just go by what you say because you're going to say, look, I made $5 million last year. And I'm going to be like, well, how much expenses did you write off? Not
Everything
much.
I could.
Not much. Oh, and then you realize you wrote off like all kinds, like 4.9.
Standard stuff.
So you made $50K.
We've had so much success around our mortgage episodes that we decided to do a mortgage Q&A where we source questions from agents in the Agent Bridge private page. We'll put a link to the private page inside the show notes so that you can join as well and be a part of the active conversation that's going on there. And I'm excited to dig into the content today and do some Q&A on mortgages and get some clarity and some understanding. Make sure you like, subscribe, and rate us wherever you listen to our podcast. Okay, so we've got a few great questions today that have been sourced from folks. So let's start with the first one. Jack Theriot. What? Therio. Okay, got it. What are the different types of loans and how do they work? And what are their fees? And so I'm guessing it's talking about FHA, VA, conventional, and how does all? I mean, that's a loaded question.
So loaded. And so I got this question this morning from you, and I'm like, look, let's do a whole episode on this one. Okay. And so that's going to be a whole episode. I'm still going to answer the question, but at a much, much higher level than I would on that episode, just because we could spend the whole time on this one question.
I agree.
So rather than go into FHA, VA, all conventional, all these different products, let's just talk into two big buckets. And let's talk conforming and non-conforming.
Okay.
So conforming loans follow the Federal Housing Finance Agency, FHFA standards. And so once those standards are met, those loans can be sold to Fannie Mae, Freddie Mac, the two government entities, et cetera. Mm-hmm. And so those loans are considered, if they follow those guidelines, less risky because, they're backed by, FHA, VA, or Fannie Mae or Freddie Mac. Mm-hmm. So if you're in that bucket, you're in a good place. It can be sold off to one of those entities and, the bank sees it as less risky.
Okay, can I ask a clarifying question on this? Is that why? Because my understanding of it is that, hey, typically these are going through originators, then they're being bundled up and sold to the government. And then that's why your mortgage, like who you pay your mortgage, like the servicer changed because those are government approved servicers to make sure people are paying their notes. Is that
not
right?
necessarily. Okay. I mean, if you have a loan closed with a lender and Fannie Mae backs it, you as the lender can still service that loan. Okay. So that's not an automatic, like it's going to be serviced by someone different.
Okay. So it's not automatic, but why is it done? Why is that servicing done by someone else?
Like, let's say that they're too exposed. They want to get some loans off their plate so they can have new loans and stuff, less exposure.
Yeah, that makes sense. All right.
So, and then non-conforming, we could go into a lot of different types of non-conforming, but a really popular one that people would understand is like a jumbo loan. Mm-hmm. So a jumbo loan's not within the conforming limits, so not a conforming loan, so not sold to Fannie Mae, Freddie Mac, FHA, VA, et cetera. And so those loans are considered to be more risky for banks and thus underwritten differently. Mm-hmm. So those are the two like big buckets. And then we could get into products on a different episode because there's so many different products, like so many, and it would just take too long.
So why is the government even involved in housing at all? Why isn't that just done by banks and, private money?
I mean, there are certain loan products that are just private money. Yeah. They want to be involved in loans because it's profitable.
Well, I think, philosophically speaking, the government wants people to be homeowners.
Yeah, well,
They want to be citizens.
But, I mean, it's
it makes them
profitable.
better. I think the idea is that it makes them better citizens if they have a sense of ownership and
I mean,
a property,
and certainly in the case of VA, look like they're trying to provide a service to people that serve their country. So,
Right.
like, I mean, there's different reasons, but like Fannie Mae and Freddie Mac, I mean, that it's profitable too. So,
Okay.
as far as fees go, we've got another question about fees later. But some products have a funding fee. So like VA has a funding fee. FHA has what's called an upfront MIP fee or mortgage insurance premium. So you think of PMI, which is something that's charged on a loan, but this is an upfront MIP due at closing for an FHA loan. That's 1.75%. VA's funding fee can be between 1.25 and I think 3.3%. So that's some fees. Lenders charge origination fees at times. There's underwriting fees charged by some lenders. Almost every product has an appraisal that's required that would need to be paid by either the borrower or the mortgage broker or whomever. Almost always, though, it's the borrower. But the rest are like, title fees, transfer fees, prepaids, escrows, things like that.
Okay, so hopefully it give you some clarity on that. But like you said, we're going to dig into this on a full episode on just that.
I mean,
that part.
some of these questions, like to really dive into it and explain it in such a way that like everybody would understand it would take like 30 to 45 minutes.
Yeah, understood. Okay, the second question, which is from Bailey Smith. What's the difference between a pre-qualification and a pre-approval?
This one you can knock out pretty fast. So I don't do pre-qualifications. I won't touch them. And I might talk in theory with someone about what I think based on what they're telling me, but I would never issue a formal pre-qualification because I don't believe in them. Mm-hmm. One, because people don't understand how mortgage brokers or lenders or whomever evaluate income, for instance. So they may give me a number and it's completely wrong because they don't understand how it's evaluated. So pre-qualifications in general are based only on what the borrower is providing you. So they're telling you information and you're giving them a pre-qualification of what you think they can afford based on what they're telling you. And so it doesn't hold water. Like it's like, I need to see proof. So that's where we get into pre-approval, where you run a credit check. So you actually see what their debts are. You actually see what their score is. You're not basing it on like Credit Karma or something like that. You see pay stubs. You see all the real information on paper so that you can give them an evaluation that will hold water, that will stand up, that will get to closing. And so pre-approvals are what you need to be getting when you're ready to shop for a home. Now, if you're a ways out and you just want to have an idea, I'm happy to talk to you about it, but it would not be something that I would issue pre-qual on because I need to see the support.
Yeah, that makes sense. I think I don't know, people don't have a real sense of what's going to be needed to get these loans approved, and a lot of times you can't just like, oh yeah, I forgot about that credit card, or I forgot about this. It's like all of those things matter from a DTI perspective, or
it can make or break it.
Yeah, it can make or break it. So it's just better to dig in.
And the answer to the next question up here will I think more thoroughly explain why it's important to dig into.
Well, then let's do that. So Bailey had another question. What does a 1099 income qualification look like?
So, and this is why I say that this will help us understand. So, when you're 1099, you're a self-employed borrower, okay? Yeah. And so your tax return now comes into play. Now, if you've been employed you've been self-employed rather for 5 years or more, we only need to see 1 year of tax returns. Okay. But if you've been self-employed for less than 5 years, we need to see 2.
Okay.
So now we're already averaging 2 years of adjusted gross income. And that's the other piece is we're looking at adjusted gross income. So if your 1099 says you made $5 million, but you wrote off $4.95 million in expenses, you made $50K.
By the way, your AGI, your adjusted gross income on your tax returns is the bottom, all the way down on the right.
So my advice to Bailey, if this was about herself, maybe it's about our client or something, but if it's about yourself, like if you've been self-employed for less than 2 years and you want to buy a home, talk to your CPA, but start writing off less expenses against your 1099 income over the next 2 years. So your average is brought up and you have a higher income. Now, your CPA may tell you, hey, we're not going to do that. We want to write off more expenses and pay less taxes. And that's okay. But if your goal is home ownership, you need to write off less expenses, bring the income up for a period of time, and then, go back to the way you were doing things before after you've closed on the home.
Okay. Good to know.
And so that's an example of like why I can't just go by what you say, because you're going to say, look, I made $5 million last year. And I'm going to be like, well, how much expenses did you write off? Not
Everything
much.
I could.
Not much. Oh, and then you realize you wrote off like all kinds, like
You're like
4.9.
standard stuff.
And so you made $50K.
Yeah. That's too funny. Yeah. All of those things are important. Okay. So number 4, what is PMI and why is it required at times? It's by Ken Franz. Sent that in. What is PMI and why is it required at times?
Yeah, so PMI is private mortgage insurance. So on a conventional loan, if you put less than 20% down, PMI is required. There's other products like FHA that require that upfront MIP that I talk about. They don't call it PMI, they call it a mortgage insurance premium. So you've got an upfront MIP that's due at closing, 1.75% of the loan amount.
Okay. And
then they also require it for a period of 11 years or the life of the loan. It depends on the particulars of the loan, but that one does not go away when you hit 20% like a conventional PMI would. All PMI does is protect the lender in case you default on your payments.
Right. So you're paying their insurance, right? So if you default on the loan, and specifically, it's like once you cross over that 20% mark, you don't need it.
Well,
right?
they feel like it's just less likely that you're going to default. So it's all about risk, right?
However, though, I think is it FHA and VA, the PMI, if you get above 20% on the value of your loan, that it stays with the life of the loan?
It stays. FHA does have a case where it can drop off in 11 years, but it typically stays.
So would the best move here, and I know we're kind of getting a little bit on a rabbit trail, so is the best move in that situation to refi?
Yeah.
Okay. Yeah.
And people know that's what's going to happen, right? So like you get to, and now if rates come down, you're going to refi sooner than that. But let's say you start with an FHA product. Let's say you had a 580 credit score, so you needed an FHA because conventional is 620 or whatever. And so you're in that FHA product and you get to a point where you're getting close to that 20% in and you want to refi into a conventional because now your score's gone up because you've been making on-time payments. That's totally a possibility.
Okay. Good to know. All right, let's talk. And then Ken had another one. What's an amortization schedule? So that's all those numbers, right? That's 30 years of payments or 15 years of payments, depending on what type of loan you get. But go ahead, jump in on the amortization.
Yeah, it's basically just a table that shows how each payment is broken up between principal and interest. And so it will show it from, if it's a 30-year loan, from year 0 to year 30, how each payment is applied. And the reason why it changes is because assuming that this is a fixed rate loan, your payment never changes. Like your payment's always the same. But the interest is calculated on the loan balance. So the loan balance is going down, so the interest is going down, but to keep the payment the same, your principal has to go up. So basically, you at the beginning of the loan, you're going to pay more towards interest, and then as the loan balance goes down, you're going to pay more towards principal. And so.
Yeah, it's a really scary number because you're like, aren't you like paying for the house twice by the time it's all over?
Yeah.
On a 30, if you stick with a 30 year, so it's best to like one extra payment a year, helps a ton. So yeah, I know. I remember the first time I sat at a closing table and saw an amortization schedule. It scared the life out of me. I'm like, I'm going to pay this much money over the course of the next 30 years. It's a lot. Yeah. It's a big number.
Yeah, it's a lot.
But yeah, I mean, it's pretty standard. All right. Okay. And then this is a piggyback off that one. And is there a difference between interest rates and APR?
Yeah.
So I think this is one of the things that people are like, okay, well, buying a car, how that's calculated, is that different from buying a house?
It's not so much that. So mortgages have this too. So I mean, like interest rate is just the cost of the loan reflected as a percentage, but the APR is, and this was required as part of like disclosure reasons in mortgages. But basically, the APR is the cost of the loan, so the interest rate plus the fees added in. So it's the true cost of the loan.
Okay.
So any sort of fees that got layered in, those are added to the interest rate to make the full APR.
Okay.
So it's a truth in lending disclosure requirement.
I see. Okay. All right. Question number 7. Why do I have to pay interest and origination fees? That came from Corey Meals in Sherman, Texas.
Yeah. So banks want to make money. I mean, I'm gonna elaborate. So
Yeah.
it makes perfect sense why they would do this once I explain. So banks deposit money if they participate in the Federal Reserve, and the Federal Reserve pays them interest. So when you hear the Fed fund rate, that's the interest that they're paying the banks who are depositing money into the Federal Reserve. So they know, like, if Brandon and I go and make our deposits into our bank and that's where we house our money, they can put it in the Federal Reserve, and that's why they have like FDIC insurance and all this stuff on a certain amount of money. They deposit it in the Federal Reserve, and they're going to make their percentage from the Fed, okay?
Okay.
Banks loan money to individuals to make money that's above and beyond what they would make in the Federal Reserve. So they're providing a service to the community by loaning money, but they're loaning it out at a higher rate than they would if it was just sitting there in the Federal Reserve. So their goal is to loan more money to make more money on the money that's just sitting in their institution. So to do that, they do these loans. And for it to make sense, it would have to be at a higher rate than the safety of it just sitting there in the Federal Reserve.
Yeah, of course. Yeah.
So because it's a riskier, so you'd have to be compensated for that. Now the fees just compensate the parties that are involved in originating the loan. So the fees are there. Well, in some cases, it's like municipalities and transfer taxes and title companies who are involved in all those things, but the origination fees are compensating the people who are originating the loan.
Yeah, those are the people who are doing the work, because they can't just get paid off the interest, right? Does it sort of make sense that way? So there's some work that's done at the beginning to get the loan through, and so that's the people making the money on that.
Yeah.
Right. They're the people who did the work.
Yeah.
Okay. All right. Number 8. Is there a certain time of month my clients should close, and why? That's Jesse Segan, and I think he's heard something about, that it's better to close maybe towards the end of the month or something like that.
Yeah, this was actually a really good question. So most people don't understand this. I explain this on every loan we do because it makes a difference. So as long as you close after the first of the month, or between 1 and 30 or 31st or 28th, or how many days are in the month, your first payment's not gonna be due to the month following that on the 1st. So let's say you close on November 1st, your first payment's not due till January 1st.
Right.
Okay. But that January 1st payment is to pay for the month of December. Okay. So something on your closing cost sheet will have prepaid interest. That's for the time you were in the home in November. So let's say you close on November 15th and there's 30 days in November. So you're going to pay prepaid interest at closing for the 15th through the 30th, but you're not going to make your first payment until January 1st, and that's for the month of December.
Okay.
So the later you close in the month, the lower your closing costs will be because the less prepaid interest you're paying.
Because they want you to pay that prepaid interest at closing.
Right.
It's not because your payment's not going to change. They're not going to add it to the payment. They're going to add it to the closing costs.
But the earlier you close in the month, the longer you wait for your first payments due.
Oh, that makes sense.
So it's
kind of a wash.
Yeah. So,
but that makes sense.
Yeah. I mean, and if you're selling another home, like, you're going to get some of your escrow account back, and so there's all kinds of stuff too. Like, but in general, if you want your closing costs to be lower, close later in the month. If you want to wait longer for your first payment, close earlier in the month.
Okay. Good. What's the fee breakdown for closing costs? This is one that people, agents especially, have trouble explaining because, one of the things we were talking about in a meeting this morning is, a lot of times the clients, depending on the relationship they have with the lender, might come back to the agent. And I do want to take a second and just sort of talk about this. This is why it's so important to have a good lender partner, because it's not your job to know all of the intricacies in the way that a loan officer is going to know them, right? That's their job to know that. And I'm not saying knowledge is bad. I'm just saying, like, they have working knowledge, and they have expertise that you're not going to be able to get because you're spending your time buying, helping people transact property. So be the connector to the expert. You don't have to be the expert. I think it's the reason we're doing this is so that you have a working knowledge. But a lot of times in the fee breakdown, it's a great idea to have a good lender partner be like, you know what, that's an RL question. Give him a call and he'll take you through every dot and tittle and make sure that you understand it as clearly as possible. And he's the real expert in this. So I'm typically, rather than trying to answer that question myself, I'm, ushering them to you. Yeah.
Yeah. I mean, in general, closing costs are going to be somewhere around 2 to 6%. And as you are now hearing that, I mean, that's a pretty wide range, and for good reason. There's a lot of different things that can occur. A lot of things go into that. So it consists of origination fees, appraisals, the credit report that was pulled, flood certs, that mortgage insurance premium we talked about, the upfront MIP for FHA, that would be on there. Title companies have expenses and title insurance on top of it. And you got taxes and transfer taxes and prepaids and escrows, which people don't really understand prepaids and escrows either, I think in a lot of cases. So like prepaids would be like you are paying for your first year of homeowner's insurance at closing. Mm-hmm. So that's a prepaid. And then an escrow would be like your taxes and insurance that are collected on your behalf by the servicer to put in an escrow account to make those payments on your behalf at the appropriate time. So you're paying in monthly installments basically towards your homeowner's insurance, towards your taxes, and then the servicer is going to make those payments on your behalf. So they collect 2 months, 2 to 3 months in escrows at closing. You've got like HOA fees that they might have a transfer for HOA transfer fee or something like that. All of those are part of closing costs. And now you maybe start to get the picture of like why I can't tell you an exact number right out of the gate. Cause like, I don't know how much the HOA charges and transfer taxes. I've seen them as high as $5,000. And so like, I could be way off. Like, and some people might require you to pay 3 months of HOA dues up front, and you might want to buy discount points or, like all these different things that come into play. And so closing costs are very specific to the loan itself. You may have really bad credit and can barely be approved for an FHA loan, and thus your homeowner's insurance policies are all skyrocketed because you're risky to the homeowner's insurance people as well. And so like that's higher and like all these different things. And so closing costs, there's a wide range for a reason.
Well, and I think what is important for people to understand is like when you're going to closing for your insurance and taxes. So you're paying insurance for the year that's coming up, plus an additional 3 months that goes in an escrow account.
Yep.
And then so insurance is paid in advance. Property taxes are paid in arrears. So they're also going to collect another 2 to 3 months of taxes just as a cushion. And then they're going to pay it for you at the end of the year, right? Yep. So both of those are going to be paid on your behalf at the end of the year. So that's a big part, but I think it's important to understand. Yeah, insurance is paid in advance. Property taxes are paid in arrears.
Yeah, and you got to remember your property taxes are for the year, and you're presumably transacting like somewhere in the midst of that year. And so like let's say that you're getting close to the end of the year. Well, the title company may require that the seller just pay the full year of property taxes at closing to make sure it gets paid on time. Well, that means you're going to be, as the new buyer, in that home for a period of time that the seller is now paid for. Well, now you owe the seller money. Mm-hmm. And so like all these things come into play to make a holistic number for closing costs. And that's why it's very hard to just say, hey, your closing costs are going to be $6,000.
Okay, and then the last one would be Alicia DePalma. How do I explain loan docs to my clients?
You should never, in any circumstance, explain loan docs to your client as a real estate agent. Alicia knows what she's doing, and she could totally knock out the park explaining them.
Sure.
She's a great agent, but in general, I would just say, look, hey, loan docs are with the lender.
Yeah.
Just like even though I know Tennessee real estate contracts like the back of my hand, if I'm operating as the lender and they say, hey, can you explain this to me? I'd be like, talk to Alicia. That's the real estate contract. Alicia needs to explain that to you, because the way that you guys have discussed it along the way may be very different than I'm about to say, and I don't want to contradict you or do so. If it's about the real estate contract and I'm working as a lender on that one, you're off to the real estate agent. If it's about the loan, send them to the lender.
Yeah, I mean, I agree. I mean, I kind of, just not to sort of repeat myself, but that's the same thing when you get into sort of disputes. Let's say they start to get pretty serious. After you go to your broker, your managing broker, let them know what's going on. Then it needs to probably go to an attorney at some point, right? When it gets to legal stuff. So the same thing on like inspections, like in a home inspection. You're not going to they're like, well, how much do you think it's going to cost to fix that? You're like, don't answer that question.
Yeah.
Right. That's going to get you in trouble if you say it's $500 and it's $5,000. Like, point them. You don't have to be the expert at everything. You just have to be the person that can connect them to the expert.
That's right.
So just make sure, as a real estate agent, because I know, lots of real estate agents are people pleasers and they want to be perceived as knowledgeable and smart and all that stuff. But the smartest thing you can do is point them to someone who actually knows the intricacies of what they're talking about. Okay. Any final words on this?
I mean, a lot of great questions and a lot of ones I would like. We didn't really get into loan products like conventional FHA, VA, all these different products. And I think that could be definitely a whole episode.
Yes.
I know there were some questions too on there that we didn't get to, like about why are there different guidelines? Well, each one of the guidelines for like Fannie Mae, for the conforming products, Fannie Mae, Freddie Mac, FHA, VA, those are like 1,000 to 2,000 page documents of guidelines.
Yeah.
And so like each product has intricacies and differences about when they're used, how they're used, how you evaluate different things. And so they're very difficult to talk about on a 20-minute episode.
Yeah, I think what we're going to do is we're going to break this up a little bit, in some upcoming episodes and give you a more comprehensive, but I think we ought to also create a piece of content or a resource for you guys so that you can have something with you as a reference for loan products and things like that, so you can brush up on them or speak knowledgeably on them in the future. So as always, thank you guys for joining us. Make sure to like and subscribe. We will see you next week. Bye.
Bye.